Volatility. Despite the fact that it ebbs and flows across all asset classes, for some, volatility inspires fear given the rapid price fluctuations. For others, volatility equals opportunity. But what if you quantified, what if you measured volatility? Wouldn't that help minimize the fear and accentuate the opportunities?
So let's start exploring bond market volatility with the MOVE index. Now, at the end of the day, the MOVE index is just a way of looking at volatility in the rate space. More specifically, for those who want more details, it's a measure of U.S. interest rate volatility, and it tracks the measurement of Treasury yield volatility implied by the current prices of the 1-month OTC 2, 5, 10, and 30-year Treasury. So using the options market to gauge the volatility. So you can see in the MOVE index for the U.S. Treasury curve, it is generally speaking flat the last few weeks. But if you look at it in a little more detail, perhaps you would have seen this back in September 2018 and later in 2019. Volatility bottomed and volatility significantly picked up after the double bottom. Yet again, of course, in the famous March of this year, volatility had bottomed previously and picked up, and once again now we are in the same place as we were just before the March uptick in volatility. We had a double bottom here, volatility picked up. Now for bonds in the US curve, potentially another double bottom just like here, suggesting strong risk over the next quarter or two that bond market volatility also is going to pick up just like it did back here. And if you look at a bigger picture, where it's bottoming over the last couple of years in terms of bond market volatility, similar to where it bottomed in 2012 to 14 and 05 to 07. So bigger picture, we are in the basing zone. Short term, we are double bottoming. Despite bonds being slow, we don't think volatility is going to remain submerged through the summer. And of course, stock market volatility doesn't have to be related to bonds, but often it is. So everybody is likely familiar with the VIX. In case you aren't, of course, the VIX is just the market's expectation of 30-day forward-looking vol using the price input of S&P index options. So again, using options to gauge volatility, you can see the VIX. Most are familiar. The high we've seen this year was similar to 08 in the 80 handle. If we look a little deeper, as we showed subscribers, you can see 48 remains a very clear line in the sand. The market, the VIX, got very close to it recently. So 48 is a line in the sand to keep a very close eye on. It's been in place for 10 years. And on a secondary note, you can see about 44 to 23. This has been the range. We start to break above this area, it would suggest higher volatility. So bigger picture, we know where the line in the sand is. We also know short term, the ranges to watch. And the third thing to recognize is that the momentum or the lack of volatility is at a 12-year extreme going back to 2008. So we know what to watch, we know the range, and we know that we are in a very complacent extreme. Suggests that the VIX potentially also over the next quarter or two is going to trend higher. And in case you think that's just a VIX story, there is of course the VXN, and the VXN is the same thing but for NASDAQ. Here you can see for NASDAQ stocks, similar line in the sand near the 48 area, gap at 40 to 25, so we know what to watch on the daily basis, and the momentum or lack of momentum is extreme, and I haven't seen it like this for the last 12 years. So be it bond market volatility, stocks, the NASDAQ, vol looks set to pick up over the next quarter or two.
So it's been a low volatility decade, a low volatility couple of weeks, and between June and August, the Northern Hemisphere summer tends to be a quiet time. But perhaps this is not a time to be complacent. Perhaps indeed, this is a time to be vigilant. Because as the charts show, volatility looks like it's on its way back.